Hello everyone. Hello everyone, and thanks for joining the course, and thanks for joining today's stream. I see we have 3 people on the stream right now. If you have any questions, especially about today's lecture, if something was not clear, post a question, send me a question. And meanwhile, I'll do a catch up on what we did today during the module, and I will dig a bit into module topics on various accounting matters. Okay, let me see if sound works. Let me check on the stream quality. 720 is available. If I do full screen, text is readable most of the time. I would probably prefer a better quality, but okay, it is as it is. Okay, so let's start. Today's topic was cost of sales. We did a bunch of exercises on inventory and cost of sales, and we discussed accounting research. For the accounting research, we created some form of our internal library. We started to create it where I put the links to accounting guidance, like the ultimate accounting guidance. The primary source of accounting guidance is accounting standards codifications. However, it is paid subscription, $1,100 a year, kind of pricey. So I prefer and I use a free guidance, and there is a plenty of free guidance available from Big 4 companies. It's a good guidance with examples. PWC has EY, KPMG, Deloitte, and other big international accounting firms. The only thing to watch here is that you do not confuse US GAAP guidance with IFRS guidance, because these companies provide both, and you make sure that you use the appropriate guidance. Usually, if it's pretty small guidance, like 40 pages or 20 pages or 16 pages, most likely it is IFRS. If you have a guidance for 300 pages, 1,000 pages, it is more likely US GAAP. I would say US GAAP guidance is a multiple of IFRS guidance in size, and it happens 95% of the time. So just do not confuse the guidance here. And we did a couple of examples, like on revenue. We are currently working on revenue, so we should be well aware of that guidance by now. Next, we did some deep in inventory today. We also checked PP&D guidance, and we also found KPMG software revenue recognition guidance, which can help us to work on some of our problems. And we also did a brief discussion that the same Big 4 companies have podcasts where you can listen to guidance updates and where they discuss accounting problems. It is mostly complex problems, so the ones which you will deal with if you have a career in corporation or in professional accounting firm which audits corporations, like PWC, EY, KPMG, Deloitte, or some big corporation. In that case, you are more interested in the guidance and podcasts compared to the situation if you when you just want to run accounting or run books for your own business, or run books for someone else's business and you simply record transactions. In that situation, you probably don't need to know US GAAP well. You can probably live without that. It's good to know it, but you will not apply it often. And for that situation, you probably are more interested in IRS guidance and just simple QuickBooks instructions. And we will handle sometime in the future, we will make QuickBooks manual for ourselves. But so far now we covered that guidance question. Let me know if you have questions about guidance. Guidance is here to guide you. Yeah, it takes some time. Typically, accountants deal with some limited amount of transactions on a recurring basis. So you will have to research guidance thoroughly one time. Maybe you will return to the guidance second time. But from there, you will kind of automate your operation, automate your transaction. You will know how to record it, and you will not return to that guidance again unless you forget the details and you didn't do that transaction for quite a while, and then you will have to refresh your memory. Or if someone updates the guidance like they like to do. The most recent update in the guidance, big one, was revenue standard and leases standard. Okay, so let's move on. The second topic for today was inventory. Here I have it. So we looked at the presentation of the inventory and we looked at the inventory guidance. And we defined that inventory is goods held for sale or items used in the manufacture of products. Okay, so that's probably intuitively clear that if we have inventory, then it is goods or items which we have to use in our production process. However, you should distinguish the inventory from property, plant, and equipment. Property, plant, and equipment is something which transform your inventory, which you use to transform. So your plant is your property, plant, and equipment, and your raw material, I don't know, coal, steel, whatever you use to produce your final goods is an inventory, and final goods itself is an inventory. So let's go to the practice. Let's go check some practice here. You can for the inventory you have basically I would say two questions. So first, your question is how do I know how to value inventory? And the question is tied closely to that question. How do I allocate inventory to the cost of sales? That's one question. And the second question is how do I value inventory at the year end and pretty much every period end. And the first question deals mostly with acquisition costs. So when you get inventory on your balance sheet, let's see. Let's assume we paid cash. So that's the entry which we do when we get items on the balance sheet. Credit, cash, debit, inventory. We should have learned that by heart by now. $17,000. Now, if we incur additional expenses related to that inventory, and not any kind of expenses, let's go to the guidance. Let's see. I think they shouldn't be far away from the beginning. Okay. In the guide here, I will share the link. Page 12. In that guidance, you will see that we have usually an inventoriable costs and not usually an inventoriable costs. So whatever we do to our inventory, we capitalize that expense most of the time, but there are exceptions. For example, cost of indirect materials and supplies used to produce your finished goods. That's a default assumption here, that whatever is on that list, it is somehow involved in producing your finished goods. Let me add some zoom here. So cost of indirect materials and supplies used in production, included into inventory cost. Okay, tools and equipment used in production but not capitalized. So if you have some tools that you do not have on your PP&D list and you use such tools in the process, you increase your value of your inventory by that amount. Cost of quality control and inspections. Of course, we include that. Cost attributable to rework, labor, scrap, and spoilage. Not included. That's an exception. And if we scroll above, we will see that is an exception. Losses from casualty and theft, not included in the inventory value. Distribution and warehousing costs, finished goods. So if we distribute finished goods from production place, from the plant to warehouses where they will sit and wait for the customer, we need to capitalize those costs. So that's capitalizable. Vendor rebates and other credits. Okay, they have some asterisks here. Let's see if they comment. Individual facts and circumstances should be consideration should be given to the impact of applying authoritative guidance, including ASC 705-20 cost of sales and services, accounting consideration received from a vendor. So usually, if you received something from a vendor, like a rebate or some a credit or some stimulus or some other kickback, you should consider whether you capitalize it or not on the cost of inventory. Depreciation for assets related to or necessary for production or manufacturing. That's included. Cost depletion, except depletion on intercompany sales. Included. That's when you amortize something. Repairs and maintenance of production equipment. Capitalizable. Utilities, capitalizable. Rent, capitalizable. Bidding costs are usually not capitalizable. That's when you buy some inventories on an auction. Engineering and design expense. Here you will need to check the guidance. Let's see. Individual facts and circumstances. Yeah. So there are plenty of different costs. Marketing, advertising, and selling not included. G&A attributable to business activities as a whole, not directly or indirectly related to manufacturing, retailing, or wholesaling operations, such as cost of recruiting, billing, and accounts receivable, not included. So it's probably easier to learn what is not included and assume that everything else is included. But the simplest test here is that you need to add to the value of your inventory pretty much every production-related expense. Income taxes, not included. Officers' salaries related to production. Okay, you need to check a guidance here. Applies to employees involved or necessary for production or manufacturing operations. Only the service cost components of net periodic benefit expense is eligible. Okay, what else? Officer salaries related to business activity as a whole, not capitalizable. General and administrative expenses attributable to business activities as a whole, not directly or indirectly related to manufacturing, retailing, or wholesaling operations, such as costs of recruiting, billing, and accounts receivable. So G&A, not related to the production, not included. Okay. While supervisory, indirect labor and supervisory wages, for example, are included. Okay, let's get back to our example. So we capitalize whatever we paid to supplier to get that inventory. And then we incurred extra work on the inventory, $20. And usually, when we first record that, we kind of allocate it to the expenses. And ideally, we want to keep our expense structure here, that we will be able to see how much expenses we incur. So I will highlight in green whatever I wanted to show here. Wait, 2. Okay, it's here. So we need, so first we incur these expenses. Of course, we can do that with one entry, and it won't be like a misstatement. I would say it won't impact your net profit, but you, at the end of the day, you want to have a breakdown of expenses, like the purchase price of the inventory, handling expense, other transformation, packaging, etc. So eventually we want to add that, and so let's see. We have handling $20, we have labor $5. Let me also update it's here. Labor 5. Then what do I have here? Packaging. In the morning session, I told that packaging can be a separate inventory account. Let's assume that was an expense account. Packaging. So we spend 100, and we have 100 items here. So that's $1 per item. Okay. Labor, handling, packaging, utilities. So that's $300, so that's $3 per item. Let's add everything else. Okay, here we have it, $199. Okay. So now we recorded all these expenses, and now we have a task of how to capitalize these expenses into inventory value. And one way to do it is simply to credit all these expenses and debit inventory for that amount. And in that case, in our income statement, we will have something like that. Since we haven't sold, in period 1, we haven't sold the inventory yet. In that case, we will have something like that. In the second situation, we can debit inventory. Now I will do 2,900. I decided to change the packaging just to decrease confusion here. Let's say it was just packaging service which we paid for. Okay, so packaging. So our amount correspond here, 2,900 here, 2,900 here. And in period 2, when we sell our products. We generate revenue. Here is the revenue. And packaging will be 0. And here it will be 100. Sorry. Okay. So when we sold under this approach, we just let's call it cost. Under this approach, we will just debit cost of inventory sold, credit inventory. Let's do that. Debit cost of inventory sold. And that will be 1990. So that's basically 100 times 199 and we will credit inventory for the same amount. So that's way one, I would say. And way two would be to credit inventory for the initial amount which we recognized, and then we will do what? So here we credited change in inventory. So now we will okay, sorry, I am a bit confused here. So we credit inventory for the same amount, then we debit change in inventory for, okay, credit should be negative. We debit change in inventory for 2900. That's already period 2. Okay, sorry, debit should be positive. And we then debit cost of sales. And for the difference, we sent to the cost of sales 700. That was what confused me. So if we look here, that's what we reflected on the first approach. That's what we reflected on the second approach, and they completely correspond. The totals correspond here and here. And net profit corresponds under both circumstances. So what's the difference? The difference is that we have presentation of the expenses that we incurred to transform our inventory. Otherwise, if we use all our payroll to transform inventory, we will not have any analytics on payroll expenses, or we will have to dig into various reports to get that analytics. So that's why we use that change in inventory account to just zero out inventory related costs. Please take a note. All of these costs should be related to inventory production, and they are covered they all should be like an inventoriable costs under accounting guidance. So that's how you figure out cost of inventory. And not on QuickBooks here. Usually QuickBooks Online doesn't have capability to do complex inventory calculations and valuations. You at most you kind of do just like you can capitalize shipping costs, or you can capitalize some other costs, and you don't do, there is no specific I don't believe there is a specific function to do all of that, and you will do that through like journal entries or through some kind of allocations which will not be straightforward. So it is available only as a workaround, and based on what I've seen. If you know a good way to allocate, to capitalize inventoriable costs in QuickBooks Online, send me a note and I will be happy to learn. However, as you can see, inventory is a complex area, inventory valuation, and it probably deserves its own course, because in university, cost accounting is like a separate accounting discipline, accounting and managerial discipline. Okay, so that's the way we deal with costs. Yeah, looks a bit complex to me, unfortunately. Unless you are in a pretty straightforward business, like some drop shipping or reselling goods without transforming them, then you will have to deal with that, and you will need to look to some more advanced software to manage your warehouse and to capitalize costs appropriately. Okay, we spent half an hour. We did some exercise on inventory costing. Let's take a look. What else do we have for today? Let's move through guidance a bit. Do I have this open? So that's all is described under accounting guidance. Spare parts, stores inventories, demonstration units, vendor rebates. So ASC 7520 provides accounting guidance on how a customer, including a reseller of a vendor's product, should account for cash consideration, as well as sales incentives received from a vendor. Under the provisions, cash consideration received by a customer from a vendor is a reduction of the price of the vendor products or services. Such payment should therefore be characterized as a reduction of a cost of sales when recognized in the customer income statement, unless the consideration is either a payment for distinct goods or services transferred to the vendor, a reimbursement of cost, or a payment for sales incentive offered to customers by manufacturers. Additionally, a rebate or refund payable if a customer completes a specified cumulative order purchase or remains a customer for a specified time period should be recognized as a reduction of the cost of the vendor products. So the most important part is here, which basically say if vendors give you a discount on some item or incentive on some item retrospectively, you need to reduce your inventory costs for that amount, unless you kind of get that incentive for something else not related to your inventory purchases. and you can also have some LIFO related issues here. Okay, let's book vendor rebate. We did one of vendor rebate a few homeworks ago. The interesting thing is that if we get a rebate after we used the inventories and after we reflected inventories in the cost of sales, we record that rebate directly in cost of sales. So let's say we got cash rebate. So we obviously debit cash, and we do that for $5 per item, 100 items, so that's $500. Now credit if not sold yet. Inventory. Credit if sold. Cost of inventory sold. So hopefully you will understand that these are two different entries. One debit cash, credit inventory if not sold. The other one credit cash, debit cash, credit cost of inventory sold if sold. If you sold only part of the inventories for which you receive a rebate, you will record it, you will allocate it between these two. Now let's see what we've got. Vendor allowances, cost of goods sold. Here is a statement about exclusion of abnormal freight, handling, and amounts of wasted material spoilage from the inventory cost pool to be capitalized. So basically, if you get abnormal expenses, you expense them when you find them. Okay, so guidance also has a specific retail inventory method. They basically use, they kind of reduce gross margin, expected gross margin from the sales price and use it to value inventory. We will not spend much time on it. However, if you deal with retail, the first thing you do on inventories, you go to the guidance and update your knowledge of retail inventory valuation. Challenges. Okay, so what are the challenges in retail? Okay, that's still retail. We don't want to dive into retail now. Inventory reserves. Again, that's all retail. LIFO inventories, same as with retail. There is two methods to account. There is more than two methods to account. Let's see, do we have a summary here? Lower of cost and net realizable value. Okay, probably not much. Basically, accounting follows the most commonly used inventory costing methods include first in, first out, average cost, and last in, first out. And here we did some research on the cost methods. So first in, first out means that when you send something to the cost of sales, when you calculate cost of sales, you first take the cost of your earliest acquisition of that inventory. So like here, when we purchased initial inventory batch at $20, and then we sold some inventory, and we used $20 as a cost, despite we purchased at 15 afterwards. And if you use that method, your closing costs of inventory will tend to your last purchase of inventories. So if your inventories decrease in price, your closing inventory will decrease in price. If they increase in price, your closing inventory will increase in price. Let me know if something is not very clear in FIFO and LIFO. And LIFO is the opposite method. In that method, you write off when you sell your inventory. You operate under assumption that the first cost you write off for the cost of sales will be the cost for your most recent purchase. In that situation, your closing inventory valuation per item will tend to your earliest acquisition of the inventory. In my case here, I assumed that we did a later purchase of inventory at a lower price. However, that might not always be the case. Usually items tend to inflate, so with time the value per item of your inventory will increase. And if it will increase, your earlier purchases of inventory will be of lower value than your later purchases of inventory. And if you write off to cost of sales at the lower rate, your cost of sales will be kind of on the lower end of the spectrum, of the possible spectrum. And your profit will be higher, which is probably good for a public company. On the other hand, for the IRS, you would prefer your profit to look lower. And that's why most of the time companies use LIFO method is because they want to pay less taxes. And under the LIFO method, when your inventories inflate, you will write off the latest purchases of inventories at an usually inflated price, and your cost of sales will be higher, and your net profit will be lower, and your tax liability will be lower. And you will have a chance to kind of flush your opening inventory. So every year in your closing inventory, you will have valuation of your earliest purchases of inventory. And if you operate under LIFO for many years, that valuation might be significantly undervalued compared to your most recent inventory purchase. So if you will need a bump in profits, you will just sell all your inventory remainings, and that will generate very low cost of sales. Please note that LIFO and FIFO, they are just accounting concepts. It doesn't mean that you need to keep actual items which you bought 20 years ago in your inventory to be able to operate under LIFO. You do not identify each individual items for these. So these methods are used when you do not identify each individual items. If you can identify individual items in your inventory, you will probably use kind of identifiable costs. And IRS generally wants you to use identifiable costs. There is a third method, weighted average method. It just averages inventory every reporting period, or maybe even every transaction, depending on how detailed they want to be. And it generates somewhat average result compared between the two methods. So under inflationary environment, like the one we have currently, your FIFO method will have the higher inventory valuation at the period end, and your LIFO method will have the lower inventory valuation, and your average method will have kind of average. We also did take a look at what was that? Accounting periods and methods. Inventory. We will dig a bit into that in the homework on this one, or maybe in the next one. But let's see what IRS says about inventories. An inventory is necessary to clearly show income when the production, purchase, or sale of merchandise is an income-producing factor. You must account for an inventory in your business. You must use an accrual method of accounting for your purchases and sales. They give you an exception, but it's actually not much of an exception. You still need to calculate and value your inventories. The only option they give you is to not keep the inventory balance, but they still want you to write off inventory only when you sell it. To figure out taxable income, you must value your inventory at the beginning and end of tax year. To determine the value, you need a method for identifying the items in your inventory and a method for valuing those items. Okay, C, identifying cost and valuing. Let's see. So basically that says that you include pretty much everything in your inventory. The same approach as in accounting standard. Okay. Merchandise, assets. IRS want you to use the specific identification method when you can identify and match the actual cost to the items in inventory. Or use FIFO or LIFO method if you cannot specifically identify items with their costs. The same type of goods and are intermingled in your inventory and they cannot be identified with specific invoices. So basically FIFO and LIFO is what IRS wants you to use. There is some variances between LIFO under IFRS and LIFO under US GAAP. But until you actually run into LIFO method, it's probably too early to learn them. Okay, so and IRS also has its own recommendations regarding inventory valuation. Under the lower cost of market value. Okay, that's a good point. Let's return to our accounting. lower costs or market valuation. Let's see. Lower of cost and net realizable value. For inventories measured using the method other than LIFO or the retail inventory method, ASC establishes the lower of cost and net realizable value rule as a guiding principle for measuring inventories. So basically, when you are at the period end, most of the time it's a year end, and you look at your inventory and you know that the price, the selling price, potential selling price or real selling price for that inventory has fallen significantly, and you paid for that inventory more than the sale price is, or I would say it the other way. You know that you will definitely make a loss on the sale of that inventory. In that case, you need to make a provision for that inventory. So you compare the cost of your inventory with net realizable value. And net realizable value is the estimated selling price in the ordinary course of business less reasonably predictable costs of completion. So that's how you do a test for NRV. You test your inventory, you compare it with estimated selling price in the ordinary course of business, less reasonably predictable cost of completion. So basically, that's what profit margin do you expect to get from that inventory. If you expect to get a loss from that inventory, so you paid for it more than you will get for it, then it's definitely an NRV provision. And that's require an application of professional judgment, and it will also require you to look at the subsequent decrease in prices. Let's see what they say here. For example, increases in prices subsequent to the balance sheet date but prior to issuance of the financial statements would likely demonstrate that the decline in prices at the balance sheet date was temporary. So if you expect that you get a loss from the sale of that inventory, but with the passage of time, of some reasonable time, before the issuance of financial statements, the prices return back to normal, and you are making a profit again, then you can avoid impairing your inventory. And let's see. However, a subsequent decrease in prices may indicate the need for an NRV adjustment at the balance sheet date. Thus, a decrease in selling price subsequent to the balance sheet date that is not the result of unusual circumstances such as abrupt and significant but short-lived changes in supply and or demand for the item generally should be considered in determining NRV at the balance sheet date. So let's go back to our inventory calculations. Here is an example. Realizable value of the inventory, which we discussed in these cases, falls to $15. Okay, so that basically means that at the balance sheet date, we need to have that inventory valued at $15, assuming there is no additional cost to sell it at $15. And in that case, here we already have 15, so no inventory provision, no impairment. Here we have a cost of 20, and we need to provide 50 for inventory impairment. And that would be debit inventory allowance That's an income statement account. Credit, let's call it inventory allowance expense. We need to name our accounts properly to avoid any confusions. And let's call it here inventory allowance reserve. So that's how we do an allowance for NRV. And in that case, we also have a small allowance, $38, in case of using weighted average method. For anyone who is on the stream today, do you have any particular questions about costs or inventories? As you might see, our cost of sales is depending on how we value inventory and how the subsequent inventory price for subsequent selling price for our inventories change subsequent to the balance sheet. So the valuation of inventory is FIFO, LIFO, or weighted average. I do not think they mention identified cost. Let's see. FIFO average cost lasting. The method selected should be consistent with the primary objective and applied consistently period to period. It says the most commonly used, but I would assume is if you are able to implement identified inventory method, when you know the cost of every exact inventory item and you sell that item and you write off the exact cost of that inventory, you can apply identified method under IFRS. So they say that the method selected should be consistent with the primary objective and applied consistently period to period. So what is the primary objective in selecting an inventory costing method is to most clearly reflect periodic income, to match specific cost of an item sold to its related revenues, which may be difficult in practice depending on an entity's circumstances. So basically they also say that they would prefer the exact match between inventory item and revenue generated by the sale of that inventory item. But they also allow you to use some assumptions. FIFO, LIFO, weighted average. While IRS guidance says that you use specific identification method, or you use FIFO or LIFO method. Okay, what time do we get? 7-10 minutes. Let's move to the homework. As I informed via the chat and Gmail, we have some kind of holidays. So next 2 weeks we will not have streams, online events. However, I will try to upload short videos on the new topics and on the existing topics, and I will share those videos with you, and we will try to do homework and catch up on on previous homeworks too. Okay, so here I have new homework 4. First 2 tasks in the homework 4 look similar to the homework 3. So you continue to create new entries for your imaginary business, and you start to book these entries to period 3, and you create period 3. Now I will not show you how to do that, as that is covered in the homework 3. So that stays as it was in the homework 3. Now, in the same fashion as I did previously, I will make some QuickBooks during the next 2 weeks. We have 2 weeks for that. I will do QuickBook videos and I will send you the problems. During these 2 weeks, I want us to complete, I would say, revenue cycle. We did accounts receivable revenue, and now I want to make prepaid revenue and cash revenue transactions in QuickBooks. And then I want to do the same with expense cycle, prepaid expense and cash expense. And we will also look into some inventory transactions in the QuickBooks. Quantity adjustment, that's for spoilage or obsolescence. And NRV, related to the net realizable value. Regarding NRV, I would assume that majority of the small businesses do not care to post it. They simply do not do the valuation. And if you have some inventories which are impaired at the year end, you most likely sell them the next year and below the cost, and then you will recognize the cost in the next year. And we probably need to look into such the tax implications of that. So will we get any tax benefits? How can we get any tax benefits from analysis of the quality of our inventory, quality and quantity? Maybe it's very worth to take inventory observation at the year end and write off any missing inventory and any obsolete or spoiled or inventory which is below net realizable value. Let's have that discussion too. We can have that discussion as part of our tax memo. And then we continue to work on our accounting memo. We will identify performance obligations in the contract. Pretty much that list is a list of performance obligations. So it will be not hard, but you will have to read the guidance, because the second part is to come up with some new interesting performance obligations related to our case based on our own research of the guidance. So just telling me or telling yourself that, okay, these are my performance obligations is not enough. You will have to read example or Google another example and read the guidance and come up with some other part which we can jam into that bundle price. And then on the next steps, we will allocate our contract price to these performance obligations. Okay, so basically that's all the homework for the next 2 weeks. Last point, complete previous homeworks. I see some people are stuck somewhere on the homework 2 or homework 3. So you have now plenty of time to catch up if you want, of course. If you stuck and don't know how to proceed, you can send me a message or contact me via Telegram or Messenger, and we can discuss for 10-15 minutes about any questions you have. So thank you for your attendance today, and have a great Sunday, and take some rest from accounting and spend a quality time with your family. You've done a great job today. How much? About 4 hours of study. 3 to 4. That's a great investment. Hopefully you learned something new. And if you think you have a valuable advice to me how to improve the quality of what I am doing, I am open for conversation. Thank you and good night.